Everything was going fine so far when the stock market recovered and made over 88% since the crash of 2020. But things are changing quickly. Sudden hike in interest rate and inflation, and the never-ending debt has put a lot of pressure on the US economy, which is giving some strong signals of an upcoming recession. All this might suggest that we are up for a very rough 2024. One of the most important indicators of an upcoming recession has been the inverse yield curve. Every time investors are looking at this graph going inverse in the past, it was followed by a recession. In simple terms, an inverse yield curve means that the short-term interest rates are higher than the long-term rates. The most important yield curve to look at is of the US Treasury bonds. See, whenever the government needs some extra cash for things like new infrastructure or pay down debt, they can issue bonds. These bonds are bought by the public in exchange of a fixed interest rate. The government and even private companies issue bonds, but the government bonds pay a little less as investors see less risk of the government not paying them back compared to just some random company. So because interest rates have been increasing from basically 0 to about 5.5% in 18 months, the short-term bond rates also increased rapidly. But still, the long-term bonds for 20 to 30 years are a lot lower than the short-term bonds. This is more of an indication of what the investors in general feel about the economy than just the return on investment. The current high bond rates are a result of inflation, and the Fed's trying to counter that by raising the interest rates. But the 5-year rates being lower could be seen as an indication of a slowdown in the economy where the Feds drop the rates again to help the country recover, like they did in 2020. And the same logic follows for the 20-year and 30-year bonds. A lot of this yield curve evaluation is up to interpretation, but here are some facts. Since the 1980s, every time we have seen the yield curve go inverse, we have soon seen a recession. Black Monday of 1987, Black Wednesday of 1992, the dot-com crash of 2001, the 2008 financial crisis, and the most recent crash of 2020, all of them happened within a year or so of the curve going inverse. Exactly like what's it doing right now. On top of all this, the inflation is about twice the target rate of 2%. The 30-year mortgage rates are hitting 8%, and still more than 60% of Americans live paycheck to paycheck. I know it all sounds scary, but all of this could go one of two ways in 2024. The good outcome could be led by steady increase in consumer spending. Like in the third quarter, the retail sales increased by a good 8.4%, showing how strong the US consumers are. All of this is putting money back into the economy and creates more jobs every month. But this leads to the bad outcome, as a lot of that much needed spending is done using debt. This has increased the overall household debt of the US rapidly. On the other hand, the wages are not increasing quick enough to compensate for this increasing household debt. We can see that wage increases were rising in the last couple of years in order to catch up to the skyrocketing inflation. But as soon as inflation got a bit into control, the wage increases started slowing down. It is natural for the employers to change the wage increases based on inflation, but it doesn't help the monthly budgets of households across the states. The same households who are either facing increasing mortgage payments or not being able to afford a house in the first place, as homes in 99% of the nation are unaffordable for the average American. Now, you as an individual can do little to change the economy quick enough, but what we can do is to be better prepared so that we can survive the storm. And the first thing to prepare for this is to reduce its impact on you. When things slow down and get bad, people and businesses with a lot of debt and no cash are the most vulnerable to getting into a lot of trouble. We can beat this by not being the average American and doing the opposite, which is to cut down spending on credit cards, reduce the overall debt, and have some cash saved. You should have at least 3 to 6 months of your expenses saved up in cash, as it will be your lifeboat in the storm. The more you save, the bigger the boat you have, and the less you are affected by the financial waves. While doing this, it's also important to remember about your long-term investments. These recessions are known for wiping out people's retirements and overall investments. So this is a good time to make sure you are not overly exposed in one investment. Have a look at your portfolio and diversify it as if you were facing the worst-case scenario, so that if you do face that day, it doesn't wipe out everything you own. Despite some good economical stats in GDP and consumer spending, everything else is pointing to a recession in the next year or so. Let me know what you think will happen in 2024. Please like and subscribe, and thanks for watching.